When China's new leaders are crowned in just over a week, they'll have little time to celebrate. Despite signs it's picking back up, the economy remains fragile. GDP growth is at its slowest in years. The main stock market has been a poor performer, and corporate profits have taken a hit. We caught up with Kim Eng-tan, S&P's Senior Director of Asia's Sovereign Ratings, to get his outlook on China.
I don't think the economy needs a big-scale reviving because from their perspective, they are not so much concerned about headline growth, which has been coming down and is causing a lot of concerns for people. Their main concern is social stability, which correlates much more closely with the overall employment situation in China.
Do you think Q4 marks the bottom of China's slowdown, and if not, when?
I believe that Q4, there's a good chance that we could see activity starting to pick up towards the end of Q4. And that largely reflects, firstly, the more stable external environment, despite the fact that the Eurozone situation remains rather uncertain. The uncertainty has become a lot less compared to early this year. And at the same time, some of the tightening measures that we have seen in China in order to bring down inflation and real estate prices have actually been reversed partially.
Are you expecting the government to introduce another round of fiscal stimulus, and in what form would that take?
We could see somewhat more supportive measures coming from the government, especially if unemployment doesn't show much improvements from here. But in fact, I don't think the measures will be very big the way you saw in 2008. And that's largely because they are more constrained now in their policy reaction compared to 2008.
What do you see as the biggest risk to China's sovereign credit rating? Is it the Eurozone crisis, or is it something more internal?
In the short term, we don't see very severe risk to sovereign ratings, which is why we have a stable outlook on the ratings. Longer term, a lot depends on whether China can sustain strong growth in the medium to long run. And that ties in strongly with whether they are successful in rebalancing their economy away from investment towards consumption. No big economy can sustain growth just based on investment.